From billionaires to bankruptcy in a matter of days. Discover how Enron, the energy giant that Wall Street once adored, hid a massive fraud that shook the financial world and changed the rules of the game forever. The rise of an energy giant. In the late 1980s and throughout the 1990s, Enron transformed into one of the most admired companies in the United States. What began as a traditional natural gas transportation company quickly evolved into an innovative giant that promised to revolutionize the global energy market. It all started in 1985 when Kenneth Lay pushed for the merger between Houston Natural Gas and Internorth. His vision was ambitious: to turn the company not just into an energy provider, but into a global energy trading platform. Lay understood that the future was not only in producing energy, but in buying, selling, and trading it like a financial asset. With the deregulation of the U.S. energy market during the 1990s, Enron saw a massive opportunity. The company began acting as a middleman, connecting energy producers with buyers, creating something similar to a stock market for electricity and gas. This model allowed Enron to generate billions of dollars in transactions. The arrival of Jeffrey Skilling as one of the company's top leaders pushed this idea even further. Skilling introduced an aggressive business model in which Enron not only traded energy, but also dealt in financial derivatives tied to energy markets. This turned the company into a major player on Wall Street. For several consecutive years, Enron was considered one of the most innovative companies in the country. Fortune magazine even named it America's most innovative company for 6 years in a row. Investors, banks, and analysts viewed Enron as the future of the energy economy. The company's stock price skyrocketed, executives became celebrities in the financial world, and Enron began expanding into new sectors such as telecommunications, broadband, and international energy trading. But behind this impressive growth and image of unstoppable success, the foundations were being laid for one of the largest corporate scandals in financial history. What looked like an unstoppable empire was actually built on a far more fragile structure than the world realized. 2. The visionary who built the empire. Behind Enron's meteoric rise stood one key figure, Kenneth Lay. For many on Wall Street, Lay was not just another executive. He was seen as a visionary capable of transforming a traditional energy company into a global financial powerhouse. Lay was born into a modest family in Missouri and from an early age understood the value of hard work and education. With a PhD in economics, his career led him to hold important positions in the energy industry and within the U.S. government. However, his true ambition was far greater: to build a company that would dominate the future of energy trading. When Lay helped create Enron in 1985 after the merger of Houston Natural Gas and Internorth, his vision was not simply to sell natural gas. His vision was to turn the company into the center of a new global energy market where gas and electricity could be traded like stocks on Wall Street. To achieve this, Lay surrounded himself with some of the most ambitious and aggressive executives in the financial sector. Among them stood Jeffrey Skilling, who introduced innovative strategies that completely transformed the company's business model. Under Lay's leadership, Enron stopped being just an energy company and began operating like a financial platform, trading energy contracts and derivatives on a massive scale. This approach attracted major investors, banks, and hedge funds who saw Enron as a unique opportunity to profit in a rapidly evolving market. During the 1990s, Kenneth Lay became a powerful figure in the American business and political world. He had direct access to political leaders, influenced energy policy, and was considered one of the most respected businessmen in the country. However, while Lay was celebrated as the architect of a revolutionary empire, increasingly complex and risky financial practices were beginning to take shape inside the company. What appeared to the public as brilliant leadership would soon reveal itself as the beginning of a much darker story, one that would shake Wall Street to its core.
Until then, the energy industry operated in a traditional way. Companies produced gas or electricity and then sold it directly to consumers or distribution companies. But Enron saw a different opportunity. Instead of simply producing energy, the company decided to turn energy into a financial product that could be bought and sold like stocks or bonds. This revolutionary idea transformed the global energy market. The main architect of this strategy was Jeffrey Skilling, who believed energy could be traded like any other financial asset. Under his leadership, Enron began acting as a broker between producers and buyers, facilitating complex contracts for the supply of electricity, natural gas, and other energy resources. Enron created trading platforms where companies could lock in future energy prices through contracts and financial derivatives. This allowed businesses to protect themselves against price volatility, while Enron earned massive profits acting as the intermediary. The company also launched Enron Online, a digital platform that allowed companies around the world to buy and sell energy in real time. At the time, this system was considered a groundbreaking innovation in both finance and technology. Thanks to this model, Enron evolved from a simple energy company into a powerful financial trading firm. Billions of dollars flowed through its operations every day, and the company quickly gained a reputation as one of the most innovative corporations in America. However, this spectacular growth also brought enormous pressure. Enron had to keep showing bigger and bigger profits to maintain investor confidence. That pressure to constantly demonstrate success would later push the company toward increasingly dangerous financial practices. 4. A corporate culture of risk. As Enron expanded and dominated the energy trading market, a very particular corporate culture began to develop inside the company, a culture based on extreme risk-taking, aggressive competition, and an obsession with rapid profits. At Enron, success was measured almost exclusively by numbers. Executives and traders were rewarded with massive bonuses if they closed major deals or generated quick profits for the company. This system encouraged employees to take increasingly risky decisions to stand out. Much of this culture was driven by Jeffrey Skilling, who promoted a philosophy in which aggressive innovation and risk-taking were considered essential virtues. Employees were expected to think like Wall Street traders, constantly searching for new ways to generate profits. The company also implemented an internal evaluation system known as rank and yank. Employees were constantly ranked based on performance, and the lowest performers could be fired each year. This created intense competition among workers who fought to stay at the top and avoid being eliminated. Meanwhile, key figures like Andrew Fastow began designing increasingly complex financial structures to maintain the appearance of constant growth. At first, these strategies seemed brilliant, but they were slowly hiding enormous risks within the company's financial statements. Externally, Enron continued to be celebrated as a revolutionary company. Fortune magazine still ranked it among the most innovative corporations in America. Yet behind that glowing image,
A corporate environment was forming where the pressure to deliver results at any cost was beginning to cross dangerous ethical lines. Over time, this culture of extreme risk would not only fuel Enron's rapid growth, it would also lay the groundwork for the collapse that would shake Wall Street and the global business world. 5. The architect of the financial illusion. Behind Enron's image of unstoppable success stood a complex financial structure designed by Andrew Fastow. As the company's chief financial officer, Fastow created a series of off-the-books partnerships known as special purpose entities. These entities allowed Enron to hide billions of dollars in debt while still reporting strong profits to investors. On paper, the company appeared incredibly profitable. In reality, massive liabilities were being moved outside the official balance sheet. To the public and Wall Street analysts, Enron looked stronger than ever. But behind the scenes, the company was building an elaborate financial illusion that depended entirely on keeping investors confident and the stock price rising.
6. The House of Cards. For several years, Enron's financial strategy worked. As long as the company's stock price kept climbing, the hidden debts remained buried within complex partnerships and financial structures. However, this system was extremely fragile. The entire structure depended on one critical factor: investor trust. If the stock price ever dropped or investors began questioning the company's finances, the hidden debts could quickly surface. What appeared to be a powerful corporate empire was actually more like a house of cards, impressive on the outside, but dangerously unstable underneath. And eventually, the first cracks began to appear. 7. The first warning signs. By the early 2000s, some analysts and journalists began noticing unusual details in Enron's financial reports. The company's profits seemed enormous, yet its cash flow did not always match the numbers being reported. Inside the company, several executives also began questioning certain accounting practices. Concerns were raised about the complex partnerships used to hide debt. Although Enron continued to project confidence publicly, whispers of doubt were beginning to circulate in financial circles. For the first time, the company's reputation as a flawless financial machine was starting to be questioned. 8. The journalism that exposed the fraud. The turning point came when investigative journalists started digging deeper into Enron's finances. One of the most important voices was Bethany McLean, a reporter who began asking a simple but powerful question: how exactly does Enron make its money? Her investigation raised serious concerns about the company's opaque financial structures and unusually complex accounting methods. As more journalists and analysts began examining Enron's reports, the company's financial empire started to look increasingly suspicious. The pressure from the media triggered broader scrutiny from regulators and investors, and the carefully constructed illusion began to unravel. 10. The collapse that shook Wall Street. In late 2001, everything began to fall apart. Investors suddenly lost confidence in Enron's financial statements, and the company's stock price started collapsing at an astonishing speed. Within weeks, billions of dollars in market value disappeared. Employees who had invested their retirement savings in company stock watched their life savings vanish. The scandal sent shockwaves through Wall Street, shaking confidence in major corporations and financial institutions across the United States. 11. The largest bankruptcy of its time. In December 2001, Enron officially filed for bankruptcy protection. At that moment, it became the largest corporate bankruptcy in American history. Thousands of employees lost their jobs, and investors lost billions of dollars. Pension funds and retirement accounts that were heavily invested in Enron stock were devastated.
The collapse marked one of the most dramatic corporate failures the business world had ever seen. 12. The auditing scandal. The scandal quickly expanded beyond Enron itself. Attention turned to the company responsible for auditing its financial statements, Arthur Andersen. Arthur Andersen was one of the largest accounting firms in the world and was responsible for verifying Enron's financial reports. However, investigations revealed that the firm had approved many of the questionable accounting practices used by the company. Worse still, during the investigation, employees at Arthur Andersen were found to have destroyed large numbers of documents related to Enron's audits. This discovery severely damaged the firm's reputation and ultimately led to its collapse. 13. Trials, convictions, and consequences. After the scandal erupted, federal investigations were launched against several Enron executives. Jeffrey Skilling was eventually convicted of fraud, conspiracy, and insider trading, receiving a long prison sentence. Andrew Fastow pleaded guilty to multiple charges and cooperated with investigators, admitting his role in creating the financial structures used to hide debt. Meanwhile, Kenneth Lay was also convicted of fraud and conspiracy, but passed away before his sentencing. The trials exposed the depth of the deception that had taken place inside one of America's most admired corporations. 13. The reform that changed Wall Street. The collapse of Enron triggered a massive crisis of confidence in corporate America. Investors demanded stronger protections and greater transparency in financial reporting. In response, the U.S. government passed the Sarbanes-Oxley Act in 2002. This landmark law introduced strict new rules for corporate governance, financial reporting, and auditing practices. Executives were now personally responsible for the accuracy of their company's financial statements. The reforms dramatically reshaped the way corporations operate and are regulated on Wall Street. Final lesson: the warning behind the empire. The fall of Enron remains one of the most powerful warnings in the history of modern business. For years, the company was celebrated as a symbol of innovation, intelligence, and financial genius. Investors trusted it, analysts praised it, and Wall Street treated it like an unstoppable empire. Yet behind the impressive numbers and glamorous reputation, a dangerous reality was slowly growing. A culture where deception replaced transparency and ambition replaced ethics. The collapse revealed how easily trust in the financial world can be manipulated when corporate power, weak oversight, and complex accounting practices combine. Thousands of employees lost their jobs and life savings. Investors around the world lost billions of dollars. And one of the most respected companies in America disappeared almost overnight. But the Enron scandal also left behind an important lesson for businesses, investors, and future entrepreneurs. True success cannot be built on illusion. Transparency, accountability, and ethical leadership are not just moral ideals, they are the foundations of sustainable success. Because in the end, Enron proved something the world will never forget. An empire built on deception may rise quickly, but its fall will always be even faster.